residential loans in an effort to try and avoid a repeat of the financial crisis. Joining us right now is Mark Olson. He is the former Federal Reserve Board governor, former Federal Reserve Board governor. He's now the co-chairman of Corporate Risk Advisors. Our guest host again today is Jim Lockhart. He's former director of the Federal Housing Finance Agency and vice chairman of W.L. Ross & Company. And Mark, thank you very much for joining us this morning. You are somebody who has been on the inside watching this as a former Fed governor. Now you're advising a lot of the financial companies. And do you think our financial system is fixed at this point?
It is not fixed yet, by any means, but I think there's a question as to how much more fixing can be done. At this point, I think that what we need to see is some recovery in the economy, and as some of your guests have said already earlier today, I think that's going to take some time. We are in a period of a very soft economy.
Our guest host today is Jim Lockhart, and I understand that you two started together a long time ago?
Many, many years ago in the same bank in St. Paul, Minnesota.
Yeah, what is this, right out of school?
Yes, for both of us.
Morning, Mark. How are you doing?
Morning,
Jim. We were at the ABA, the American Bankers, a while ago, and also a couple other conferences. And there's talk now that the medium and smaller sized banks are going to have significant problems going forward as they have to realize losses on their commercial loans and their construction and development loans. What is your thinking about what should be done for them?
Well, I think, first of all, I think you're absolutely right. Over the past decade, certainly, the medium-sized banks have found a niche in commercial lending. And I think the commercial lending underwriting standards had been improved over what they had been in previous period of time. But I think that with that concentration and with the softness in the commercial real estate market, there are undoubtedly some unrealized losses in those portfolios. And so I think the first thing that needs to happen is a realistic assessment of what those values are.
Do you think that this is going to be a situation, Mark, like we saw back in the 1980s, where it was really starting at ground zero for looking at commercial real estate?
It's a very Becky, it's a very different environment. In the 80s, what you had is you had banks that had worked all the way through the resolution process, that had been taken over by the FDIC and then passed on to the RTC. And so what came on the market was real estate. Today, what will come on the market are real estate loans. That real estate is still in loan portfolios, and that has to be treated much differently. So I think what the solution now will not be the redistribution of real estate, but I think the refunding of some of those loan portfolios.
I mean, is that a better scenario? Because it just means some players are going to get burned, but you still have the real estate there, and maybe some value will be found underneath that?
It's a better scenario because we're addressing it earlier. And I don't think we'll see the fundamental revaluation of commercial real estate across the U.S. That we saw in the late 80s.
You know, Mark, we've had a big debate here today, just trying to get a sense of how much credit is available, how much is needed. We just heard from the NFIB, who talked about how small businesses, only 4% of those small businesses say that their #1 concern is finding credit. And I certainly would have guessed it was a much higher number based on the anecdotal evidence we hear. What's your sense of the availability of credit for medium and small-sized businesses?
Well, first of all, fundamentally, banks need to lend money. The bank model is based on the presumption that you're going to lend. They have a lot of deposits that they need to deploy, and there's only so much of a margin available in the investment options. So banks, for the most part, especially the medium-sized banks and the small banks, need to lend. So banks are looking for good loans. On the other hand, and what we have, and I think somebody said it earlier in this program this morning, there is a fair amount of unused lines, both for consumers and businesses. So we're still seeing a significant amount of caution, both among lenders and among borrowers. Now, on the lender side, there is caution because we're still a soft economy, and loans that were expected to be performing loans in a rising economy are not loans that you would make in a soft economy.
Mark, the Federal Reserve is in a very tricky spot. They have flooded the system with liquidity, not only through rates, but through a bunch of other programs that have been deployed. Right now, the economy very likely still needs it, but when will they know, and will they be able to pull out at the right time?
Well, that's going to be a very difficult, a very tough call, and I think that will be done very carefully. And I think there will be a couple of metrics that they'll watch very closely. One of them, of course, will be for inflationary pressures. If one of the things that the Fed is enormously good at is to be able to sense inflationary pressures. And I think that for anybody that sits on the Open Market Committee, that's the first thing on your mind, is guarding against inflationary pressures. On the one hand, the process of reducing the liquidity can be done fairly slowly and in measured amounts, but I think that that will depend on the strength of the economy and the extent to which they're feeling inflationary pressure.
Mark, the Federal Reserve, we were talking about earlier, has bought over $1 trillion in mortgage-backed securities. Treasury has a couple $100 billion. How do you see them selling those, or can they sell them at any point? Carefully.
I think that the ability, to unwind positions, though, the Fed is very good at, and I think the money desk in New York, on a literally a minute-by-minute basis, can measure the changes in liquidity, and there's a good history in terms of how putting some of those securities back on the market will impact both liquidity and interest rates. And so I think that the unwinding of a position is something that will be managed, I think very, very carefully.
Mr. Olson, we want to thank you again for joining us today.
Thank you for the invite.
Again, Mark Olson is the co-chairman of Corporate Risk Advisors. He is also a former Federal Reserve Board governor. Coming up on Squawk, we have more from our guest host today, Jim Lockhart, plus golden opportunities. Gold's at a record high, but will it go even higher? We've got that and much more when Squawkbox comes back right after this.
Stick with us on Squawkbox. We've got the pre-market info you need before